Good afternoon, everybody, and welcome to the Wednesday lunchtime drive-through on Wednesday, July the 12th, 2023. We are now more than halfway through the year. The second quarter has ended, and we now move into the third quarter of the year. And if you've been watching the drive-through throughout the year, you know pretty well now that we have been projecting that sometime by the end of this year, there's a very strong probability that we'll enter into a recession. However, we're not there yet, and we don't know for sure. So that's that talk, that message has kind of dominated the first half of not just our drive-through, but many of the conversations we've been having with our clients. And we continue to be defensive for many of our clients because of that. However, today I wanted to talk about a topic that doesn't get talked about a lot, but it should, especially for you who are on this call, because you are millionaires and aspiring millionaires. You are working toward that. And the simple fact is, when you have money, more opportunities are available to you. That's just the way life is. And so, one of those opportunities is unlocking the power of your non cash assets. And it's the same strategy that billionaires are using and even multimillionaires. They are unlocking the power of their non-cash assets, and you can do the same. Now, before we get too much further, if you have any questions throughout today's presentation, please use the chat or Q&A button down below. You should see that in your little toolbar. It should be at the bottom of your screen, just over that. And if you've got a question or a comment, you can use the chat or Q&A function. My name is Damon King. I always forget to introduce myself. I just assume everybody knows who I am. My name is Damon King. I'm a certified financial planner and wealth manager with ChappelWood Financial Services, the sponsor of the Wednesday lunchtime drive-through. And I'm also the lead instructor for ChappelWood University, which is the educational branch of ChappelWood Financial. So welcome to the drive-through. So let's go ahead and get started on unlocking the power of non-cash assets. So first, let's define what a non-cash asset is. It probably doesn't really need much of a definition. I'm sure you can probably figure this one out on your own, but here we go. A non-cash asset is anything that is not liquid and would need to be sold to be converted to cash or generate cash flow. Now, not necessarily cash flow. Some assets generate cash flow by themselves. So really what that means is if you want cash from that, if you want to access the value of that asset in the form of spendable money, you would have to sell it. So that's pretty much anything: stocks, bonds, real estate, precious metals, minerals, business, art collection, land that you own. It doesn't matter. If it's not money in your hand or in your bank account, it's a non-cash asset. Now, while they're not liquid like cash, you can't spend your shares of Facebook, you can't spend your oil well, these assets do tend to appreciate over time much more than cash does. And that's why we own them, right? You just stick all your money in cash, you're not going to earn very much. It's safe, relatively, but these non-cash assets obviously have much more appreciation potential over time than simple cash does. And they tend to generate income over time, certainly much more income in the form of interest than cash does. And for the vast majority of people, including all of you good people on the call today, the majority of your net worth is likely tied up in these non-cash assets. You could even throw the value of your home in there, the value of your cars, the value of life insurance policies that you own. So most of your net worth, most of your wealth is tied up in non-cash assets. When we visit with our clients and we show every single one of them their gold buckets and they've got cash in the bank. Now that's bucket number one. Everybody's got cash in the bank. The other three buckets of money that we have are non-cash assets for the most part. So the guarantee of principal bucket, it's probably going to be things like, you can have CDs in there, which are cash-like, but you can also have things like treasury bonds, government treasury bonds. Those are non-cash assets. They function like a cash alternative in terms of interest and risk mitigation, but they still have to be sold in order to reap the cash from that. They have to be redeemed. You would also find things like annuities in that bucket. Then you've got your stocks, bonds, and mutual funds bucket. Everybody knows what those are. And then you've got your fourth bucket, other. That's where your real estate, your precious metals, your minerals, business interests, things like that would go. So most of our clients, and up at the top, if you've got a $3.5 million liquid wealth, the vast majority of that is going to be non-cash assets. So how do you go about unlocking the potential of those non-cash assets? And keep in mind, today's presentation is not about that you must do this. It's to get you to think about your non-cash assets in a different way. So here's an example. This is something that happens frequently. We'll have a client call up and they'll say, I want to go buy a brand new car. And we'll ask, okay, well, how much is the car going to cost? Well, it's going to cost about $50,000. Okay. How are you going to pay for that car? Well, we've got cash in the bank. We could pay cash. Okay, that's fine. Or we can go get a loan for it. All right. So you're going to either use cash or you're going to get a loan. Now, sometimes they might say, well, what about if we sold some of our stock that we have in our joint investment account or our trust account or something, and then you send us the money? We can certainly do that. However, when you sell assets, especially appreciated assets, what does that do? Number one, you no longer own the asset. You don't have it to grow, to benefit from, that sort of thing. And if it's an appreciated stock, it's going to generate a capital gains tax. So the only value in a non-cash asset is realized when you sell it for cash, right? Or is it? What if you could access cash from that asset while maintaining ownership and control over the asset? And in addition, what if that cash that you received from the asset was not taxed as income, tax-free? It is possible to do this. The key is using leverage. Now, instantly, when you saw that word, and I said the word leverage, I know what a lot of you did. You tensed up. You're like, ooh, leverage. Leverage. Isn't that debt? Aren't you talking about going into debt, Damon? I am. However, not all debt is the same. We are conditioned to believe that using debt is always a bad choice. I don't want to be in debt. I don't want to owe anybody money. I understand that. Trust me, I do. I don't want to be in debt either. But there's a specific kind of debt I don't want to be in. I don't want to be in credit card debt. All right. Most people, okay, if you grew up and if you listen to Dave Ramsey, all right, what kind of debt do most people have when they call in? A lot of it is student loan debt. All right. But I would even argue that a student loan is not that bad of a debt because it is tied to a valuable asset, assuming you're using the degree or the schooling for which you have the debt. If you got a student loan for a major in 17th century French literature, I'm going to go ahead and say that was a poor choice. Okay. Nothing against 17th century French literature, but you can't really turn that into a marketable career. I mean, unless you're going to teach or something like that. Not all debt is a poor financial decision. Usually that's true of credit card debt. However, if it's debt leverage that is tied to an income producing and or appreciating asset, it can often be a wise decision. And companies and governments already know this. That's why they sell you bonds. That's all a bond is. It's a loan. When you buy a bond, you are making a loan. You buy $1,000 bond from IBM. You are loaning IBM $1,000 of your money. In exchange, they are going to pay you an interest rate on that loan. And then at some point in the future, they promise to pay back your $1,000. In the meantime, you get the benefit of the cash flow from the income. What do they do with your $1,000 and all the other $1,000 they borrowed from other investors? They go out and invest it in other things, research and development, marketing, what have you. And if they're paying you 5%, but they're going out and earning 8% with the money that they borrowed from you, they're making money. They're earning money off of that, right? That's the power of leverage. So companies and governments leverage themselves all the time. And why would you buy a bond? Because you believe that IBM is a strong company, probably going to be around for a while. Maybe not. Let's use Microsoft instead. We should get updated. IBM is so 20th century. Let's get into it. You believe that Microsoft is a strong company. They put out good products and they're going to continue to be around and they have good cash flow. So there's a really good chance that that $1,000 you let them borrow, that you loan to them, is going to get paid back, right? Well, wealthy people also know this. And they also know always use someone else's money, right? Don't use your own money. Always use somebody else's money. Now, it's easier said than done, but there are ways to do it. And wealthy people do this all the time. In fact, you might think, well, wealthy people, they pay off all their debt. They're not in debt. Hell no. Wealthy people have a lot of debt. Most wealthy, like I'm talking mega rich, ultra rich people, they have a lot of debt. But it's leverage that is tied to other assets they own. So Warren Buffett borrows cash against his various companies to buy more real estate. He's a billionaire, right? And he's got all of these assets that he would have to sell to generate the cash. But instead of selling those, generating a bunch of capital gains taxes, no longer having the asset, and then taking the cash to go buy another asset, he simply borrows against the assets that he already has to go out and acquire more assets. Elon Musk, how did he buy Twitter? Did he have billions of dollars in cash sitting around to do that? No. What he did was he leveraged his billions in stock from PayPal and different companies, and he went to the banks and borrowed against those stocks, used them as collateral to get loans from the bank to go buy Twitter. Now he has still the stocks that are appreciating in value, paying dividends, what have you, and now he has Twitter, which is also generating income. Of course, now with Meta, Facebook put out Threads. I don't know if you saw this, but there are a lot of people leaving Twitter and going to Threads, which is a new social media platform similar to Twitter, but it's owned by Meta, which is the parent company from Facebook. So Zuckerberg is trying to stick it to Elon Musk. But that's how leverage works. That's how wealthy people get wealthier. Wealthy people stay wealthy because they know that they can access cash through leverage to invest in other things to make them wealthier while still owning the assets that made them wealthy in the first place. And what's even better, when you take a loan against an asset that is appreciating in value or that is generating income, that loan is tax-free. Loans are not considered taxable income. And in some cases, the interest that you pay on that loan may even be tax deductible. There are situations, if you get a home equity line of credit or a home equity loan, tap into the equity in your home. Everybody, you all know that, how that works. There are many situations where the interest on that loan is tax deductible. So not only are you getting tax-free cash flow from an asset that in and of itself doesn't generate a lot of cash, you are also potentially getting a tax deduction on the interest that you pay for the loan that you're taking. Doesn't always work, but there are times when that can. So what are the typical terms when you decide to leverage an asset that you own? All right. Well, for one thing, if you're going to do this with an investment account like stocks, bonds, or mutual funds, you can't do this with an IRA, not with the traditional or a Roth IRA. All right. This has to be, if you're going to use securities, stocks, bonds, and mutual funds as collateral for a line of credit or something like that, it can only be done with after-tax accounts like an individual investment account, a joint account that you have with yourself and a spouse or someone else, or a trust account, something that you get a 1099 for every year for dividends and interest. You cannot use an IRA for a line of credit. But assuming you do get the line of credit, whether it's on an investment portfolio, a house, rental properties, a business, whatever, often when you get that line of credit, the institution that provides this line of credit, usually a bank, often doesn't even require that you pay down the principal. You just have to pay the interest. So for example, when I went and I got a home equity line of credit, I wanted to fix up my house. I wanted to improve our bathroom and kitchen, and my wife and I wanted to renovate the house so that we could sell it. We went out, instead of invading our cash, which we could have paid cash straight out, but we didn't want to do that because we knew we were about to move soon and we needed to preserve our cash. So what did we do? We tapped into the equity in our home. We took out a line of credit equal to about $20,000. And we could choose to use all of that or none of it or half of it, whatever it required to do the renovations we wanted. When we signed the paperwork, the only payments we had to make were interest. So long as the interest payments were made every month, that's all that was required. We didn't have to pay back the principal until later on when we sold the house. All right. So it helped to manage our cash flow, and we still got the project done, and the renovations actually increased the market value of our home over and above the interest that we paid on the home equity line of credit. That's why when you are using debt, when you're using leverage to acquire or improve another asset that you have, often the other asset that you're going to acquire has more value than the price of the loan or the borrowing of the money that you're paying. You're still coming out ahead, right? That's why, back before interest rates really started going up and you could get a car loan for 1.5% if you had really good credit. Okay, so I've got a client and he bought himself a $90,000 Corvette. He always wanted a brand new Corvette. It was special order and it took months to get it, and he finally got it. Now, he could have paid cash for it easily. However, instead, he went to the bank, he got a 1.5% loan from the bank, and then he took the $90,000 that he would have used to pay for the car and put it inside of an 18-month CD, paying him 2.5%. Now, 2.5% is not much, but it was more than the car loan, right? He was getting paid more to sit on his cash than he was paying on the loan. And that is when leverage can be a wonderful tool. All right. Now, the other thing you may not even have to make a payment at all. There are situations where, let's say you take out a line of credit against your investment portfolio. And when you do this, let's say, you take out a line of credit equal to, I don't know, $500,000. And then you go out and you buy something and you spend $100,000 of the $500,000 credit. You've used 20% of the value of your line of credit. All right. That means you've got $400,000 more of space to use in your line of credit before it's maxed out. Instead of you writing a check every month to pay the interest, you can actually let the interest accrue and let the line of credit itself pay the interest. So you borrowed $100,000 against the line of credit. Now you don't start paying interest until you start using some of the line, right? Now the next month comes and now there's an interest payment due. And let's say that the interest payment is $5,000. I don't know. You could write a $5,000 check or transfer $5,000 to pay that, or often what you can do is simply let the line of credit pay that. So now your line of credit is, instead of 100, it's 105,000. And the next month, same thing. You just let this accrue so that you're not actually using any of your cash. Meanwhile, you're nowhere near maxing out your line of credit of $500,000. And at some point in the future, you plan to pay off the line of credit anyway, maybe because you're going to sell a house, or you're going to sell a business, something. You're going to come into some cash. Now, one thing you have to keep in mind is your loan to value ratio, or your LTV. What is the value of the asset that you're borrowing against, and what is the value of the loan? All right. If it climbs too high, you may have to make a payment to get it back down. The point is that this cash flow, when you use leverage, when you borrow against non-cash assets, this cash flow is tax-free. And like I said, the interest you pay on the loan may be tax deductible. All right. So here are some different strategies that you can use whenever you're thinking about leveraging some assets. For one, a HELOC or a home equity line of credit. So if you got a paid off house, or your house is worth 500,000 and you owe 100,000, 500 minus 100 is you have $400,000 in equity, right? And you can borrow against that. That's what a line of credit is. Or you can take a loan of the entire amount. I preferred the line of credit because I didn't want to use all of the equity in my home. I just needed a little bit. Same with your investment portfolio. We have clients that use what's called a securities-backed line of credit. It's the exact same concept of a home equity line of credit. In this case, you're using your stocks, bonds, and mutual funds as collateral to secure the line of credit instead of your house. And again, this can only be done with after-tax accounts. It can't be done with an IRA or other tax-deferred account. You can borrow against insurance policies, specifically cash value insurance policies. If there is a life insurance policy you have, and it's got a cash value, so that would be a whole life policy or a universal life policy. This would not include a term life insurance policy because term life insurance does not accrue a cash value. There's no cash value in a term life insurance policy. But you can borrow against the cash value of insurance policies, or sometimes even the premiums that you pay in. What about borrowing against the value of other property you own, like rental properties? Depending on who you go to, you might even have, let's say you own $300,000 in precious metals, gold and silver. You may be able to go to some bank and they may be willing to loan you a certain amount of money against the value of the silver and gold. So don't just assume you can't do this or that you don't qualify for these things. Ask, talk to your banker. Hey, I've got $500,000 in gold and silver and I need some cash. Would you guys make a loan to me if I put up half of the gold and silver as collateral? They'll probably say yes. If you've got a good relationship and they're going to run your credit and all that sort of thing. Okay. And they're going to probably want to see evidence of the asset that's being held as collateral, right? Or talk with your financial advisor. Those of you on the call today that are members of the ChappelWood family and you've got after-tax accounts that are not IRAs, and you have thought, you know what, I wouldn't mind having a little bit of extra gunpowder on the sidelines if I need it. Can I open a securities-backed line of credit? Very likely, yes, you can. Again, it can't be used for IRAs, but it can be used for individual investment accounts, joint trust accounts, that sort of thing. So let's give some examples here. So in this case, you're going to borrow against your stock portfolio. So let's say you own $1 million in stocks and you want to go out and purchase a $300,000 investment property, a rental property, something like that. Rather than use your cash in the bank or to go get a loan from another bank or from the bank, or to sell your stocks and thereby lose those assets to raise the cash, instead, you open a securities-backed line of credit against your $1 million. Now, you're likely going to get access to 50 to 60% of the $1 million. Okay, so your line of credit, you're not going to get 100% access to it, but in most cases, they'll give you 50 to 60% of the value. So, you may have access to anywhere $500,000 to $600,000. You only need $300,000. So if you open up the securities-backed line of credit, you're going to get the cash you need, tax-free, and you're going to avoid triggering any capital gains taxes that might be there because you're not selling the assets to raise the cash, you're borrowing against them. You get to keep the assets. And as the market continues to go up, you still get the benefit of the growth of those assets. If they're dividend-paying stocks, you still get the benefit of the income that comes from those stocks. Here's another example. Borrowing against life insurance. So let's say that you have $250,000 in cash and you wanted to earn more interest. All right. So you go out and you purchase what's called an indexed universal life insurance policy, or an IUL policy. Now, this is a special kind of life insurance that it functions like any life insurance. There's a death benefit, and then you name beneficiaries, and if you die, they get the death benefit. However, one of the benefits of indexed universal life is that it builds cash value, and that growth, that interest that it earns, is tied to the performance of the stock market, much like an indexed annuity. If the stock market, like the S&P 500 index, goes up, you earn interest. If the index goes down, you can't lose any value, but you don't earn any interest. But the real power here is that you could fund that IUL policy in equal installments of cash, say $50,000 per year over a 5-year period. The policy earns interest when the market goes up. Later on down the road, something comes up. You want to take a big trip to Australia or to New Zealand, and it's going to cost $30,000. Now, you've got some cash you could access, but you want to use that to spend on the trip when you're there. You could sell some of your securities, but that's going to trigger capital gains taxes, and you'd really like to keep those stocks instead. Or you'd really like to, you'd want to keep the stocks. Instead, you could borrow against the cash value inside your life insurance policy. That again is tax-free income. Some people just borrow from them just as regular cash flow. It's almost like another retirement account. And here's the deal. You're asking, well, if you borrow against a life insurance policy and it doesn't get paid back before you die, doesn't that reduce the death benefit your family gets? Well, yeah, it does. But in the case of an IUL policy, you're not buying it for the death benefit necessarily. What you're buying it for is to park some cash that ordinarily would sit in your bank account and earn you 0.5%. Now you're going to put it into the IUL policy, let it build cash value, and later on you can take tax-free loans against that cash value and supplement your cash flow in retirement. People do it all the time. Here's another one, borrowing against real estate. Let's say you have 5 paid off rent houses and they're worth $1.5 million total. And they're all positive cash flow. All of your rent houses are rented, so they're free and clear, and they're generating cash flow for you. Now, another property comes up and it's one you've really had your eye on. You just like, oh man, if that one ever comes on the market, I want it. And now it's on the market, but you don't have enough cash, okay? There's not enough cash in your bank account to pay for it. How do you get this property and jump on this opportunity, but preserve your cash? You go to your bank and you say, look, I've got $1.5 million in cash flowing properties as collateral. Here's what I'd like to do. I'd like to ask you to loan me, will you loan me half the value, $750,000, to go out and purchase the new property that I want? And the cash flow from my other properties, which are paid off, is going to help me to pay back the interest on the loan. And eventually I'll pay back the line of credit or the loan. Will you do that? They're probably going to say yes, especially right now. Interest rates are higher, right? Banks want to loan you money. They do, because they're going to earn more interest off of you. Okay. So, and now with fewer people buying homes because there are people that can't afford a mortgage. So lending has gone down. Banks are looking for people to lend money to. When you have wealth and you have avoided other kinds of debt, you have options. And these tools are available to you. Leverage is power. So I want you to change your mode of thinking that all debt is bad. Some debt is stupid. Credit card debt. You know, last Christmas, you went out to eat with your friends and you spent $55 on a steak. And you still haven't paid off the $55. You're paying 18% interest on a $55 steak from 7 months ago. That's pretty stupid, right? But some leverage, some debt is very powerful, because the loans in those cases secured by those assets those assets have income and growth potential to actually grow your wealth over and above the cost or the expense of paying for the loan. And the loans that you receive from these are tax-free. When you use leverage like that and you acquire another asset, you actually make yourself wealthier by going into debt. I know that sounds crazy, but you can't. People are doing it all the time. And you also potentially increase the legacy to your family. When you use leverage responsibly, you're essentially turning your non-cash assets into your own bank. You're borrowing from yourself. You are your own bank in a case like that. Now, you have to use leverage responsibly, right? I'm not advocating that you just go out and borrow. Don't leverage yourself to the hilt. There are people that do that. Well, that's dumb too. You've got to use it responsibly. If the asset the debt is tied to depreciates or is in some way damaged or lost, or you don't have it anymore, well, you're probably going to have to pay that loan back, or you're at least going to have to make a payment so that your loan to value ratio gets back into balance. And you always need to be aware of your loan to value ratio. Okay. You've got to use leverage responsibly. But every one of you on the call today, you didn't get to be as wealthy as you are by being stupid. Okay. And I know the vast majority of you on the call today, you didn't get wealthy by getting lucky and winning the lottery either. You did it from hard work, taking advantage of opportunities. I know you could be smart enough to manage this, all right? And it can be very powerful to you. Different types of debt use different loan to value ratios, but 50 to 80% of loan to the value of the asset that you're borrowing against is pretty typical. Ultimately, it's like Vegas. When you go to Vegas, don't ever gamble with money that you cannot afford to lose. Well, never leverage an asset that you are not prepared to sell if necessary to cover that debt. All right. So only leverage things that you would prefer not to sell them, but it isn't going to kill you if you do have to sell it. Okay. So, any questions? We're just a little over 1 o'clock here, but any questions, any thoughts on that? Do some of you guys think I'm just off my rocker and that I'm pitching snake oil here? And if you do feel that way, that's okay. Like I said, I know that we are conditioned to believe that all debt is bad. Trust me. What set me on the path to becoming a financial advisor was the fact that I was in serious credit card debt in my mid-20s. I know how terrible debt can be. I've been there. I went hungry. I didn't have food because I couldn't afford to buy food, and I had to work 3 jobs to get out of the debt. But I have since learned not all debt is bad. Some debt can be very, very useful and powerful for you and your family. All right. Doug and Jennifer say, I needed to hear this. Dave Ramsey got me so twisted about debt, and I know that you can use it for good. Looking forward to exploring it more. Absolutely, Doug and Jennifer. I'm the same way. Look, I listen to Dave Ramsey, and I believe in 90% of the stuff that Dave teaches. When you are in serious credit card debt and your cash flow and your lifestyle's impacted, yes, you need to batten down the hatches and get that debt paid off. But once you are generating great cash flow and you have wealth, there are opportunities available to you. All right. And let me say this, Dave Ramsey is a multimillionaire. Do you honestly believe he pays cash for everything? Probably not. I bet even Dave Ramsey has some assets that are leveraged. That's what the wealthy do. And there's nothing wrong with it, so long as you know yourself and you use leverage and debt responsibly. So great comment there, Doug and Jennifer. Thanks so much. Last thing I'll share with you here. This is a 3-part course for millionaires that I put together. Just scan that QR code, get your phone, open the camera. You can click on that, and that's going to take you to a page where you can subscribe or you can register for my 3-part course. It's free, and it talks about income planning. We've got a tax planning module in there, and I think it's just healthcare planning, something like that. But that's a really great course that I offer to anybody. And if you've not ever been through it, you can do that. So I don't see any other questions today. I want to thank you so much for sticking with me a little longer than normal. I hope you enjoyed today's topic. And of course, if you have any questions about any of this, you can always email me, damon@chappelwood.com, or you can text me at 405-348-0909, and I will reply to your question. I'm here all the time. They never let me leave. Okay. I get to go home, sleep, and then come back. And you know what? I love it because I love what I do. Thanks so much. We'll see you next time on the Wednesday lunchtime drive-through. Bye-bye.